when it comes to some of that commentary surrounding the weakness that we are seeing within the labor market, of course, that then begs the question, now that there seems to be a lot more attention from Fed officials on some of that weakening in the labor market, does that at all, I guess, change or alter your risk of recession and then further that movement there that we could see as a result in the bond market?
Not really. I think, I think the market is definitely pricing in a non-zero chance. I think maybe about 25% at least as of this morning, a chance of a recession in the next 12 months. I think our base case still remains of soft landing, if you will. I know it's a pretty cliche term, but soft landings are bumpy. Data is not giving you a very clear sign. And I think one big assumption here is also that we are very confident that the Fed has a lot in its toolkit to avoid that sort of hard landing, if you will, or a massive recession. We are moving away from a restrictive policy to less restrictive policy, not moving into very dovish or very easing policy at this point, because that is not what our base case is and not what the economy is actually warranting right now. So we are not moving into a recessionary time frame where the Fed is actually rushing to cut. Here, I think they are recalibrating. And I think this goes back to probably the soft landing that they've been guiding us towards. And I would say that the Federal Reserve central bank here and Chairman Powell can actually declare a victory a little bit here at the end of the year.
So if this is the Fed's victory lap, what does that do to your investment thesis? If you're talking to folks, where's the biggest opportunity across the curve if we are in that victory lap phase?
I think the 0 to 7, 0 to 10 year part of the curve is very attractive. I think that dual mandate of fixed income, I think one is providing that income in a client's portfolio, and then second being a hedge or bringing that negative correlation to the riskier part of your portfolio is proven again in the last 6 weeks of 3 weeks of volatility that we've seen, the volatility that we saw in risky markets around the regional bank crisis that we had we were getting into in the first part of 2023. I think that hedge capability of fixed income as well as the income capability, that dual mandate, is really evident at this point. And that's why if you look back the last 2 years, ending July 31, intermediate fixed income, that 0 to 10 year part, if you had like a 6 year duration portfolio, has outperformed a money market portfolio. So we do think that that 0 to 10 year part, the steepener, if you will, in the portfolio should work really well.